Welcome to the 2025 Capital Insight Partners Economic and Market Outlook. Thank you all for joining us, and we really hope you find a lot of value in today's discussion. For those of you who don't know me, my name is Steve Mahan. I'm a senior portfolio manager with the firm, and I'll be moderating our discussion today. I am joined by three wonderful members of our investment committee. So here to my left is our Chief Investment Officer, Craig McRory. We have co-founder and partner, Susan Anastasiadis, and fellow senior portfolio manager, Sarah LeClaire. The team today is going to cover a wide range of topics in our discussion. We'll touch on everything from the economy, markets, technology, and they'll give you some of the things that they're really focused on as we move into the new year. But before we do that, I think it'd be a little bit helpful to maybe do a quick recap of how markets did in 2024. So last year, market indexes had a very strong year, in particular large cap US equities. So what you're seeing on the screen here is a graph that shows you performance of large cap US stocks, small and mid cap stocks, international stocks, and bonds. And that blue line represents large cap US stock indexes, finishing the year up around 25%. Small and mid cap stocks, pretty good year, up about 11%. More modest performance for international equities, up just over 5%, and a volatile interest rate environment really weighed on the performance of core bonds, with bonds giving you about right around 1.3% on the year. Now, if you really look under the hood of that performance, I think you see some pretty important things, because while the top line number looks pretty good, there was really a wide discrepancy among the leaders and the laggards in the market. And you see that by this chart here. What you're seeing here is the performance of the S&P 500 by sector. So if you look at the left-hand side of that chart, the top four sectors in the S&P all returned over 23% on the year. But that's a pretty wide difference between the laggards, the bottom four sectors in the S&P 500, which all saw returns of maybe mid to low single digits. So while everything was positive, you had a big gap between the winners and the losers. And if you were to drill down even further into this and look at individual stocks, despite that return of up around 25% for the S&P 500, half of the stocks in that index actually finished the year in negative territory. So we had I think the story of the year, while it was pretty strong at the top level, it was the story of really a wide discrepancy between those market leaders and the market laggards. So as we move forward and look into 2025, now, I think a great place to start would be to just look at the overall economic backdrop. So, Craig, I'd like you to kind of kick off our conversation about the new year with just how we see the current state of the economy today.
Yeah, thank you, Steve. Appreciate that. If we look at this next visual here, our view is that the domestic economy remains healthy, driven by a very strong consumer. And so as we gauge to determine what goes into how do we look forward to determine what that actual growth of the economy looks like, we look at a couple of different factors. So if you look at the image here on the screen, you can see on this particular chart there are two different measures that we're looking at. One is the unemployment level. The other is the rate of inflation. So historically, when we look at the level of employment, full employment for the economy is around 4%, which you can see over the last couple of years, we've been right there. And that's generally been driven by the demand and supply of available jobs has been healthy, more so than the actual number of employees that are eligible to work. So again, we have more jobs than eligible employees, so that's remaining to be a strength in the economy. The second is the level of inflation. So while the Federal Reserve would like to have a level of inflation of around 2% or slightly above that today, we're still within range of a normal cycle as far as still propelling growth in the economy. And the last measure, which isn't on this chart here, but what we look at to kind of project where our economy is going, is interest rates. And so historically, over the last 50 years, the federal funds rate has been on average 4.6%. And just in December, at the last Federal Reserve meeting, they decreased that rate to between 4.25% and 4.5%. So again, we're within that range of growth in the economy. All three of those factors are showing strength.
Oh, okay. So it sounds like things are pretty healthy, like in particular here in the U.S. On that topic of interest rates, mentioned 4.25%, kind of close to the 50-year average. I mean, rates have really moved, and expectations around rates have really moved markets. over the last couple of years. What's our expectation for maybe Fed policy in the new year, and where might interest rates go?
Yeah, good question. At that most recent Fed meeting in December, after they reduced rates down a quarter point to 4.25 to 4.5, they introduced the idea of a return to a normalized or neutral interest rate policy. And so what that means for us is kind of twofold. Is one, over the last couple of years, we've seen prices or inflation of goods and services go at a pretty elevated and fast pace, whereas wages or income hasn't kept up at that same pace of the price increases. And so as these numbers suggest, we're kind of entering a normalization or a healthy kind of economic growth in the economy. And so they're taking a pause from an interest rate standpoint to see where we go next as far as do wages actually begin to catch up with that price inflation that we've seen. With the new administration coming in to office here in the next couple of weeks, we're also seeing that there's an agenda that they've had on the campaign trail, and they're determining to see what that actual plan is for those policies to be introduced and what the magnitude of those actual implementations may look like. So they're looking to kind of wait and see where that looks like. But really, from the economic and where we're headed, we think that rates are likely going to remain neutral here for a while. But with the overall trend actually coming down a little bit. So we would expect over the next 12 to 18 months that rates maybe settle somewhere in the mid to high 3% range.
Gotcha. Okay, so more stable. I mean, maybe slightly lower, but
Yeah.
much more stable than we've seen in the past. Okay. Sarah, I'd like to bring you in on this because as I mentioned before, the last couple years, expectations around inflation and interest rates really moved the markets a lot. And if we are entering a more stable environment, I guess I'd pose the question to you of what are some of the things we expect might move markets in 2025?
We do feel that for the first time in a few years, the attention is going to be more on companies' performance and their ability to really drive returns from producing earnings rather than being influenced around the discussion about where interest rates and inflation may land. If you look at the S&P 500 for some perspective, which represents the largest companies here in the U.S., analysts are estimating that earnings should grow at about 14.5% for this upcoming year, which is significantly higher than it has been over even the last few years. Now, the expectations are really high for companies to start delivering because a lot of the discussions in the last few years have been more about the future potential of earnings and around a lot of buzzwords and really optimistic management guidance, which has drove more margin expansion or the amount that people are willing to pay for a company, often referred to as like a price to earnings or PE ratio, that has grown a lot more than the earnings actually have. So we think this year the story is more going to be about companies being able to deliver on those results and actually show that they can produce the earnings that have been discussed.
Gotcha. Okay, so focus on earnings in 2025. Okay. I know from the client conversations that I have, from the discussions that we have in our investment committee meeting, that one of the other things that is of focus moving into the new year is obviously the new administration coming in. There is an awful lot of different policy proposals and things like that as of today. We're filming this on January the 8th, so a lot more to come. But in our discussions, what we tend to focus on when it comes to how the new administration's policies might impact the economy and markets is really on deregulation, it's on tariffs, and it's on tax policy. So I'd like to kind of have each of you take one of those subjects, and Craig, I will start with you. Talk a little bit about our expectations on deregulation and how that might impact markets.
Deregulation is generally a good thing for economies. And so when you think about companies and where they can spend capital, if they're spending less money on regulatory oversight, they're able to spend more money on growth, innovation, and earnings for shareholders. And so that generally is a positive. So as you can see here on the next visual is specifically for deregulation, economic growth usually goes up. It's neutral on its impact on inflation, so not much there. And where we're really looking at is from a benefactor standpoint is as companies are out there looking to grow, is generally the first person that's willing to release that capital are banks. And so domestic banks are usually going to be in favor during a time of deregulation. And so when you think about that, when companies are looking to expand and grow, is the first place they're going to look at potentially is just to raise more capital through the traditional banking system. In addition to that, we also think that mergers and acquisitions or M&A activity also stands to benefit during a period of deregulation. And so again, kind of going back to the idea of if the economy is looking towards growth is that as companies are exploring how they grow, they're either going to look internally or they're going to look externally. And so that is an opportunity for companies to see, well, maybe there's a peer that maybe would be more aligned with their values. And also, as an example, as we look at it, is within the healthcare space in particular, is biotechnology really kind of is a good example of this type of activity, where you have smaller companies that are innovating from a technology standpoint. They're looking to grow, and they're either going to look for a peer to combine forces or potentially align with a larger entity that will add on the resources and capital to allow them to continue to grow. And so in both cases, that mergers and acquisitions activity is favorable in that standpoint. In addition to that, we feel that technology companies, while they've been beneficial over the last few years, with a looser regulatory environment, that will also allow them to continue to grow as well, because they can continue to focus more of their capital on growth and innovation as opposed to legislative affairs. And so lastly, kind of summing that up too, is an additional area of the landscape that we feel could be a benefactor is the energy space. And just as we've seen an increase in demand the last couple of years in energy and the consumption of, the demand for, that actually with lighter legislative policy allows them across all spectrums of the energy landscape to continue to grow to meet that demand.
Nice. Okay. So deregulation, something sounds like we expect it, and it sounds like it has pretty broad impact
Yes.
Across a lot of different industries. Another key focus of the new incoming administration that I hear a lot about is trade policy and the potential of tariffs. Sarah, can you give a little background on maybe how we're thinking about potential tariffs and how they might impact different companies and thus markets?
Yeah, I'd be happy to. So tariffs have been in place forever, but the level of which they've existed have changed over time. And right now it feels like the magnitude and application of tariffs might be very broad regionally or on more specific goods, which may impact some companies over others. And while it's still unclear what those may shake out to be, we should start learning a little bit more about that in the coming weeks. They may be used as a negotiation tool. But generally speaking, when we think about tariffs, they are negative for economic growth and tend to be inflationary. Now, it is important to note that U.S. companies are actually the ones paying the cost of tariffs. And so that could end up reducing demand on foreign goods and encourage more companies to be buying domestically produced or U.S. company-based products instead. And so when we think about potential benefactors from a higher tariff environment, the companies who are already operating in that landscape could stand to benefit. Now, U.S. companies can either choose to take on the cost of the tariffs or pass them along to consumers. But the reality is, in the last few years, especially post-COVID in 2020, consumers have already been taking on a bulk of those increased costs with the higher inflation that we saw at that period of time. And as Craig mentioned, people are still feeling the impacts of higher prices in their budgeting today. And so generally speaking, we think that the companies are going to choose to bear those costs, which may ultimately start to impact their profit margins. So while tariffs are still speculative for the moment, internally a lot of our discussions have been focused on investing in businesses who can easily pivot and navigate this environment and think and figure out ways to be able to drive shareholder value beyond this period of time where we may see an increased level of tariffs in the marketplace.
Got it. Thank you. So again, a lot more to come on tariffs, but sounds like we're really focused on companies that can be flexible in a changing environment. That brings me to you, Susan. Last thing that we're talking about a lot is tax policy. Tax Cuts and Jobs Act expires this year. Give us a sense for how we're thinking about that and maybe what, or how that might impact investors.
Yeah, so the Trump administration has already indicated that they're supporting corporate tax cuts on Social Security benefits, and no taxes on tipping or overtime. But in addition, in 2017, like you mentioned, the Tax Cuts and Jobs Act was implemented, which lowered income tax levels and corporate tax levels, increased the standard deduction, and increased the estate tax exemption limits. And that is set to expire in 2025. The Trump administration, however, is supporting extending those as well. So we have a lot of tax policy changes on the table, and it really sets the stage for economic growth for corporations, for business owners, and for individual investors. Now, before you get too excited, of course, each of these changes has a hefty price tag with it. Just extending the existing policy right now would cost a $4.5 trillion. So it's likely to be met with some resistance by Congress.
Gotcha. Okay. Thank you for that. And then there's obviously a lot going on when it comes to policy, and a lot of this stuff is up in the air. I feel like we live in a time where there's just more noise generally, and anytime you get a new administration, is simply going to add to it for the new year. So Susan, I'd like to ask you, in light of all that noise or potential noise, I mean, what do you think investors should really be focusing on when it comes to politics and how it might impact their portfolio?
Yeah. Well, I'd have you look at this slide that has just been pulled up here. So if you took $10,000 and back in 1961, you invested only during the time when a Republican was in office, you'd have around $100,000 today. If you took that same money and only invested during the time when there was a Democrat in the White House, you'd have around $577,000. But if you shift your eyes over to the right-hand side of the slide, you'll see that if you just took that money, that $10,000, and invested it back in 1961 and never took it out, just kept invested, you'd have nearly $6 million today. So really what this is highlighting, and kind of a reminder for everyone, is just, to keep your emotions in check with regard to investing and just stay invested. It really is the best way, and really will pay off, especially in light of this year where there could be, more volatility in the markets due to all these policy changes that are out there. Remember, we're invested in companies that have earnings is what is really going to be what matters, not so much the political landscape. So just keep that in mind and stay invested.
Thank you. I love that perspective, and it's also a good segue into maybe moving into the markets a little bit. So, I mean, Craig, I will start this with you. Just broadly, give us a sense for where we see the stock market today, and how we are expecting things to play out maybe in 2025.
Yeah, much of what we've talked about so far today has been about some of the economic backdrop that provides further tailwinds and, in our view, supports further growth in the stock market. And so when you think about that and drill down to what Sarah just mentioned a moment ago, in 2025, U.S. domestic companies are expected to have double-digit earnings growth. That's massive. The new administration is expecting to focus very much on the domestic economy, another potential tailwind for the U.S. markets in particular. So, and also add to that is the American consumer or American employee is now saving a little bit differently than done in years past. They're actually spreading that out over multiple, let's say, dollar cost averaging into the markets. They're doing more so on an index basis or a broad basis. So it really provides a foundation for continued market growth over many, many years. So in that view, we really see those as being continued strengths. In our view, the reward is there for 2025. As part of a team, we're also looking at some of those risks as well. And so as you think about some of the risks that may kind of change our view or the landscape, would be continued geopolitical risk. So that's been in the last couple of our conversations as far as outlooks, that continues to be present. We've got stock valuations that are elevated. So when you're looking at buying company stock today, it's more expensive than average. You've also got market concentration, where in the U.S. here, about 1/3 of the U.S. stock market by size is in technology companies. So there's definitely risks out there. The largest one that we also look at too, that is the most unknown, frankly, is just the behavioral risk element. So typically around some form of current event, there's normally an emotional response to something, and usually it's an irrational response, but it usually drives for a potential market correction in the nearer term. So those are more difficult for us to plan for, but these are the types of things that we're looking at as we're developing the portfolio of securities that we do, as well as the stock bond mix and portfolios. But weighing all those things together, we do feel that the reward is greater than the risk into 2025.
Okay, gotcha. So broadly positive, I would say. Sarah, I'd like to bring you in on this, my next question, because you mentioned those risks, and the two that I hear a lot about and read a lot about are elevated valuations and market concentration towards the top. So maybe, Sarah, give us a little bit on how we think about that here at Capital Insight Partners.
Yeah, and I think it's an important discussion for all of us to have. As Craig mentioned, the concentration in top 10 securities broadly do represent about 37% of the S&P 500 right now. And I'd like to bring up a chart that actually pairs the valuation piece to the concentration to help illustrate the story. Those top 10 companies are represented by the green line on this graph. As you can see, they're much more expensive than the rest of the market. Now, granted, they've also performed really well over the last 5 years, so given their performance and their higher valuation, their general, given the weight that they represent in the market too, that's pulled up the valuation of the overall market. Now, I think it is important to note, though, that these companies are producing a tremendous amount of free cash flow, operating earnings. They're also spending a lot on R&D expense for future opportunities. So we do feel that the landscape is supportive of their dominance continuing, at least in the near term. But when we look at the rest of the market, as represented by the gray line on this chart, those areas of the market are not nearly as expensive and create some good opportunities for us as well. Now, all that being said, our valuations are not always a good market timing tool. The market can stay expensive for an extended period of time, especially when there's a lot of positive sentiment in the backdrop and there's still some economic stability as well. Now, what we saw at the back end of last year are that returns from stocks broadly are starting to represent more sectors in the marketplace. And we think that that's going to continue into the year ahead, especially as investors are more actively investing and we're getting those investment flows into the markets over time. Now, that's not to say that we do think rather that maybe we might experience a breather or two in the markets and some of that breath to come out. But those create good buying opportunities because at the end of the day, we do believe that the markets will end at a higher level than they did to begin with.
Gotcha. Okay, so we're certainly paying attention to the valuation, certainly paying attention to the concentration. But it sounds like we're really expecting a broadening of the market in 2025 to some extent.
Yes.
Okay. Susan, that brings me to you. Given that backdrop of how we're kind of seeing markets today, what are some action steps that investors should be thinking about in their portfolios?
Yeah, well, investing is always a risk-reward trade-off, and so we've had a couple years of good stock market returns. So now's probably a good time, if you haven't done so already, to take some of that equity exposure off the table by capturing some of the gains. And if you are an equity investor, it's a good time to reallocate to some different equities that have opportunity. Mm-hmm. If you're more of a balanced investor where you have stocks and bonds in your portfolio, it's a good time to revisit your asset allocation because you likely will be overweight equities at this point. So again, capturing those gains in equities and reallocating to bonds is a good idea. Bonds right now are paying favorable coupons still, so we like bonds, so it's a good time to be buying bonds. Keep in mind, if you're investing with us, we've been doing this for you, but it is good practice to do that now. The other thing I'd say is just keep dollar cost averaging into the market over the year. There'll definitely be opportunities to buy, like Sarah mentioned earlier.
Okay. That's great, and it's great, like broad kind of asset class perspectives. But Sarah, I'll go back to you on this one. I mean, can you give us a sense for what we at Capital Insight Partners are kind of doing under the hood right now when it comes to what we're doing in both stock and bond portfolios?
Yeah. So a lot of our discussions as a team have been surrounding potential policy impacts, the continued strength in the economy and the consumer, possible pathway for interest rates, as well as thinking about a lot of the opportunities that we want to be positioned for going forward. So I'd like to answer your question in actually two different lenses, if I could. So I'll start on the stock side. Given the dominance of the U.S. markets and the continued investment that's being placed there, a lot of the trades in our portfolios as of late have been preferring or having a preference for and overweighting U.S. securities over international markets. And within that, looking to buy more large companies than small to medium-sized ones. And if we drill down a little bit further on the sector side, there are some areas of the market that we're excited about and we're leaning into, some of which we'll get to talk about next. Shifting over and thinking about the bond side of the portfolio, the magnitude of potential fiscal policy could maybe cause inflation to reaccelerate a little bit. And a reacceleration in inflation could actually cause the Federal Reserve to pause cutting rates for a bit. They may extend that for an extended period of time and let the data really show us how that might play out. Or in an extreme case, they may reverse course and start raising rates. We don't think that's as likely at this point, but we'll have to see how that all settles out. All that being said is we do expect some continued volatility both in interest rates and in the bond markets. So we are positioning portfolios right now to be a little bit shorter duration on the short end of the curve, investing in higher quality bonds because, as Susan mentioned, the coupons to start the year are attractive. And so over the long run, you can kind of expect to get about a coupon's return out of bonds. So given their higher level of starting point, we do think it's going to be a favorable year for bond investors as well at the end of the day.
All right. Well, thank you for that. And before we did this today, I asked each of you to kind of send me a theme that you're focused on as we move into the new year. Sarah, you said artificial intelligence. Susan, you said cybersecurity. And Craig, you said increased capital expenditure. So I want to give you each a chance to kind of flesh that out a little bit. Sarah, I will start with you with artificial intelligence. So talk a little bit about why you're focused on that in 2025.
Yeah. I've been excited to have this conversation, so I'm glad that we're covering it. You know, there's been a tremendous amount of private investment that's gone into artificial intelligence, or AI as I'll call it going forward. I'd like to draw your attention to the chart up on the screen. If we look at just 2023 alone, $60 billion was invested in US companies to support the efforts on expanding artificial intelligence, which, as you can see, is significantly more than the rest of the world. Now, I think it's important to note that there are companies who are involved in the development and supporting of building the AI, and then there's a whole subset of companies who are going to stand to benefit from applying and utilizing AI technology in their businesses. So I'll highlight a couple of areas of the market for you. The first being in the utility space. When we think about AI, there is a tremendous amount of energy needed and grid support and data centers and all these pieces for the cloud infrastructure that need to be built to support this technology. So companies in the utility space and materials should actually start to benefit from that in time. The second place is on the industrial side. There's a lot of opportunity to really optimize supply chain management in their manufacturing processes. And a company like Manhattan Associates, which our clients generally might either own directly or indirectly within their portfolios, build out like manufacturing softwares and use AI within that in order to really help their companies be able to create a lot of forecasting accuracy for their own supply chains. So that could be an area. The last of which is in the healthcare space. There's a tremendous amount of use cases that we can look to as examples for this, but first one that comes to mind today is actually the ability to work through data in a much quicker fashion helps reduce the time and cost that it takes to take a drug discovery process and trial to market and bring those life-saving drugs to market a lot quicker and more cost effectively as they that more than they have previously. And on, you know, from an individual person, just the diagnostic and being able to use the technology to like look at radiology scans and identify diagnoses much quicker than the human eye could. So a lot of use cases of how this technology can be applied in the world, and a lot of investment opportunity to come from that as well.
Yeah, that's interesting. I think originally when I think of artificial intelligence, I think of tech companies, right? And it's like it's so much broader than that. Susan, I'll go to you. Now you mentioned cybersecurity. Talk a little bit about that and why you're focused on it.
Yeah, well, like Sarah mentioned, our AI has a great opportunity ahead of us, but there also comes risks with that. Cyber attacks have gone up tremendously because of AI. And it's getting harder and harder for people in our business, for example, to protect assets that we have. And also just any company out there has data of client data, and it's hard to keep that secure now. So there's a large money spend towards cybersecurity these days. I mean, even our company, we spend a lot of money just buying cybersecurity insurance. So we feel like it's a real big trend coming, and so I thought actually I'd use this time to give you a few different best practices that we utilize at Capital Insight Partners, but also our primary custodian, Charles Schwab, utilizes to help protect assets. So Schwab really relies on technology as the primary way that they kind of work at making sure your assets are safe. For example, they use behavior data analytics to monitor transactions that might appear odd. If something pops up, they will notify us so we can be aware of it. In addition, anytime money leaves an account, they will reach out to the client and notify them. They also utilize dual authentication when clients are logging in to Schwab, and they use Voice ID if you're calling in to Schwab. So again, a lot of resources around technology there. At Capital Insight Partners, we also have best practices in place. For example, when clients are wanting to wire out money, they're often corresponding with us through email. However, we won't only use email as our way of communicating about that. We will call and make sure that you are the actual person on the other end of the email. These days, you never can quite tell. So that's kind of a practice that we utilize to help protect assets for us. And then in addition to that, we also, have seen in the last year or so really an uptick in check fraud attempts. And so we really would encourage people to either totally stop using checks or, minimize the amount of check writing you do. There's other ways to send money that we would prefer, which include ACH, wiring, or even, setting up bill pay. So anyway, a lot of best practices there. We've been talking about a bunch of negative things with regard to cybersecurity, but you can make money on this space too. And so we've decided that because there is so much money spent going into cybersecurity, we would like to add this type of a company to our investment model. And so we've done so by purchasing the company Checkpoint Software. So hopefully we can take this negative and turn it into a positive in the form of stock profits for our clients.
Yeah, okay, that's great. Yeah, I mean, it probably has a pretty long runway with cybersecurity, I would guess.
Right,
yeah. Craig, you had talked about increased capital expenditure was your focus, so bring us home.
Absolutely. So on this next slide, you can see here, by definition, capital expenditures is really the increase of spending from a company into goods and services that will allow them to continue to innovate and grow. And so when we look back over the last several decades, going back to the 40s, you can see there have been periods of time where there's been these booms in growth and spending. And so as we think about the last couple of years, while there's been tremendous amount of expense on AI infrastructure and data center and cloud computing infrastructure, as we look historically, we're still below average when it comes to that spend. And so this is a big part of our thesis as we think about the future and the economic growth and the market opportunities ahead of us, is that our view is that we expect this to continue to grow and expand over time. And so an example of that in our portfolio today has been the company Oracle. And so we've owned that name in our model portfolios for several years in accounts. And what we're really seeing is that convergence of data center build out, cloud computing migration, the AI evolution, they've really been in that sweet spot of growth as far as their applications being deployed there. So when we think about where we're going, this is a big part of that story for us. And as Sarah mentioned in her slide just a moment ago, is much of that spend over the last couple of years has been focused on the United States. And our expectation is that that growth in the United States continues to grow, so that gap continues to widen of growth in the U.S. versus the rest of the world.
That's interesting stuff. It seems like that's a pretty good tailwind for the market moving forward.
Yep.
We'll thank all three of you today. Thank all of you for tuning in. I know we covered a really wide range of topics. I think to give just a high-level summary of what the team's expectation is for 2025, I would say broadly speaking, we're pretty positive. We think the economic backdrop is a solid one. We think that despite the fact that we're entering the year in parts of the stock market where you do have elevated valuations, we think that positive economic backdrop combined with a lot of the tailwinds that the team highlighted sets up for a pretty good year for U.S. equities. And we think higher interest rates mean that bonds will most likely yield you a return that equals about their coupon. And we think bonds will go back to providing the diversification from equities and income that they have in the past in portfolios. So overall, once again, broadly positive. And I'd like to maybe turn it back over to Susan just for some final thoughts.
Yeah, sure. So like I mentioned earlier, you want to just stay invested and try to, this year, keep your emotions out of investing. Also, I would just say that really focus on, what matters to you. As an investor, what your appropriate asset allocation is based on your risk tolerance and your stage in life, and what the right rate of return is for you to meet your goals. we can help you determine all these things through the use of a financial plan. So if you haven't done one already, I would advise clients to reach out to your advisor and do a financial plan. And if you have done a financial plan, it's always a good time to check in, make sure you're on track to reach your goals.
All right, I love that. That's a great place to end it. Once again, thank you all for joining us. Thank you for your partnership. We look forward to a great 2025.